Hi, I'm JD Davids, and this is the Ohio Venture Pipeline covering the first half of 2025. We're going to look at three themes in this session. We're going to start with current trends in venture capital nationwide. Then we're going to look at Ohio's deal flow specifically, and then we're going to talk about ways that we can grow our slice of the pie when it comes to venture capital. I moved back to Ohio a few years ago after spending 25 years in California building venture-backed companies. And one of the first things that I realized was that there's a lot of interesting deals happening here in Ohio. There's just not a lot of people that know about them. For example, last year, over 295 companies raised approximately $1.3 billion of venture funding last year. And when I tell people that, they say, wow, I had no idea. And that's exactly why we do the Ohio Venture Pipeline. Our mission is to shine the spotlight on all the great entrepreneurs who've successfully raised venture capital here in Ohio and are building their companies right here. We've been producing the pipeline for over 3.5 years, and this is our sixth semi-annual presentation. Here's some of the photos of our All-Stars at the Ohio State House at our last event in May. You may recognize some of these faces. And here's the full class of 2024 Ohio Venture Pipeline All-Star Award recipients. I'm also excited to let you know that we're going to share some of this year's nominees in today's presentation. But first, I want to tell you about the data lake that we've built. Every quarter since January of 2022, we've been scrubbing and tagging and compiling all venture-style deals completed by Ohio-based companies. In 2022, we had 214 deals that raised $2.4 billion. In 23, we had 269 deals that raised $1.4 billion. And last year, we had 295 deals that raised $1.3 billion. In today's report, covering the first 6 months of this year, it includes 146 deals that raised approximately $790 million. Now that amounts to 920 deals that have raised $5.9 billion for Ohio-based startup companies. And as we compile this information, we're collecting over 40 data points on every deal. So that puts us in a unique position to do some fascinating data analytics on Ohio's deal flow. I'll be honest, it's a lot of work, and we couldn't do it without the support of our sponsors. Book+Street supports the Ohio Venture Pipeline and many of the entrepreneurs in this region with accounting and financial solutions. And Spoke Design also supports the Ohio Venture Pipeline and many in the region with graphic design and marketing services. Now, all the work that goes into the Ohio Venture Pipeline has a very important purpose, and that's to create high-paying jobs. Now, I've always known that VC-backed companies create jobs fast, but I never had a statistical source to prove it. But thanks to the National Venture Capital Association, we now have that source. The NVCA, in partnership with two other groups, commissioned a study that looked at 67,000 venture-backed companies over a 30-year period. And they determined that venture capital-backed companies grow jobs 8 times faster than any other source of net new private sector jobs. And they also determined that even during economic downturns, it still grows jobs 4 times faster. We also have some great examples of that already here in Ohio. CoverMyMeds was the original unicorn in Ohio, and they currently employ approximately 1,800 people right here. Now, Upstart is an example of what I like to call backdoor venture capital, meaning that the company's headquartered outside of Ohio, but they're creating jobs here in the state. Upstart's based in San Francisco, and they have 1,600 employees, and at least 500 of them are in Ohio. Anduril is also an example of backdoor venture capital. They're only 8 years old, and they already have 6,000 employees nationwide, and they've committed to creating 4,000 jobs right here in Ohio. And Intel. Well, if you know anything about Silicon Valley, you probably know that Intel was one of the very first venture capital deals, and they're planning to build one of the largest semiconductor fabs in the world right here in Ohio. So it's fair to say that venture capital at scale has already had a major impact on job creation right here in Ohio. So with that in mind, let's take a look at the state of venture capital across the nation today. A quick warning, we're going to go through a lot of information in a short period of time, but I'm going to put a link below where you can download all of the slides. So venture capital is really all about the flow of money. And I like to say that there's a supply chain for venture capital, and there's a lot of variables that it can affect how fast and how efficiently that capital flows to the startups that need it. This chart shows that quarterly fund flows for the last 10 quarters, and you can see that Q1 of this year had a nice uptick to over 80 billion, but Q2 investments fell back a little bit below the fourth quarter of last year. Most analysts are cautiously optimistic about increased activity in the second half of this year, but that depends on interest rates and several other factors that we're going to talk about in a minute. When we look at deal count, it's an obvious steady decline in the number of venture deals getting funded each quarter. And this is primarily because of the lack of exits over the past few years. And VCs are doing fewer deals with larger dollar amounts to keep their late stage portfolio companies going until the exit activity picks back up. But the good news is the explosion of investment in AI. This chart shows the percentage of total venture capital investments going into AI dominant companies versus everything else. And the trend here is obviously up and to the right. 58% of the venture capital dollars and 36% of the deals went into AI dominant companies so far in 25. And that trend's likely to continue. So if you're a startup trying to raise money and you're not AI dominant, I would encourage you to consider going in that direction. And if you read the news headlines, you know that just a few companies are soaking up billions of dollars of capital, round sizes that we've never seen before. In March, OpenAI closed the largest venture capital round ever, raising $40 billion at a valuation of $300 billion. That's not bad for a company that's only 10 years old. And to put that in perspective, the valuation of GE Aerospace is $298 billion. So investors are putting massive amounts of money to work because AI is not just the next big wave. It's bigger than all of the waves of technology before. There have been 4 major waves of technology disruption in the past 30 years, and this chart reflects what percentage of VC deals went into each phase. It starts on the left with the internet in 1995, which is the year I moved to San Francisco. The mobile internet comes next, and then followed by cloud computing, and now Gen AI. And that pink triangle in the upper right, that shows cloud computing and Gen AI are consuming nearly all of the venture capital flowing in the market. While AI continues to dominate headlines, it doesn't operate in a vacuum. The pace and direction of capital flow are directed by much larger forces. So let's take a quick look at the macro trends that we're tracking that impact the flow of venture capital today. Inflation and interest rates definitely have an impact on the flow of capital. The Fed lowered rates by a quarter point last week, and we expect more coming in the later part of the year. It also helps to understand the current pace of GDP growth. We also look at corporate growth and earnings each quarter. It's helpful in understanding how consumers and businesses are making their purchasing decisions. And recent disruptions or uncertainty around tariffs and taxes are impacting both spending and investment decisions until the dust settles. But exit activity, IPOs and acquisitions of venture capital-backed companies, this is one of the best leading indicators of how venture capital is likely to flow in the near future. So let's take a look at how exit activity is shaping up so far this year. This is a quarterly chart of exits by VC-backed companies over the last 4.5 years, and you can see that the last few quarters are starting to tick back upwards. You may have also seen some headlines about IPOs this year, and this 5-year chart shows a similar trend in IPOs. But the one thing that's really important to mention is how many of these exit deals are where the acquirer is another venture capital-backed company. This chart shows on the left that 10 years ago, 80 to 90% of the acquisitions were done by industry gorillas looking to capture new products and rapid revenue growth. Now, obviously, that trend is changing as more and more VC-backed companies are the ones doing the acquiring, with 31% of the deal value and 35% of the deal count being transacted by other VC-backed companies. It's also important to realize that acquisitions are happening much earlier than they used to. On this chart, the brown area represents acquisitions of seed stage companies over the last 10 years as a percentage of all exits. The aqua color is Series A companies that got acquired. And if you put those two together, they make up like 60 to 70% of the exit deals. And that's much earlier than most entrepreneurs are used to thinking about. Even at the bottom in orange, you can start to see pre-seed deals starting to creep up as a percentage of the total acquisitions. The other trend I want you to be aware of is what I like to call a partial exit or a secondary market transaction. So secondaries are ones where VCs that weren't able to invest at the beginning, they still won on the deal. So they buy shares from the earlier investors as well as some of the employee team shares. In fact, this chart shows that the amount of VC dry powder that is dedicated to secondary transactions is at an all-time high of $9.8 billion, and more than half of that is a 2024 vintage. We're also seeing a continuing trend that the time between investment rounds is getting longer. This chart shows the number of months between financing rounds. And starting on the left with the seed to Series A, the median number of months between seed and Series A is about 28 months. And as you can see, the trends are stretched even further in later stages. Now, to be fair, this does exclude bridge rounds, but the takeaway is that entrepreneurs need to find ways to manage cash and extend their runway in line with the current fundraising environment. So, with all that in mind, I'd like to share some advice for the entrepreneurs. The first thing is to realize that the rules of the game are different in this type of environment. When things are going well, the VC game historically has been all about top-line revenue growth at all costs, because revenue is one of the key factors in determining the exit value of a company. In today's market conditions, however, the game is more about cash is king, and VCs are asking, how long will it take for you to get profitable? So for that reason, the most important thing for entrepreneurs is to watch your cash burn rate very carefully in this environment. David Sachs was the COO at PayPal, and he was the founder of Yammer with a unicorn exit, and now he's a VC at Craft Ventures. Now, David talks about the cash burn multiple, and it's a measure of capital efficiency. So to calculate your number, you take the net cash burn of your company and you divide it by the net new ARR, which is your annual recurring revenue. And if your number is above 2, he recommends making expense adjustments. And if you can keep it below 1, then you're being very capital efficient. Now, this is hard to do, admittedly, but these are wise words from an experienced hand at this business. The second piece of advice for entrepreneurs comes from one of our All-Star nominees for the class of 2025, Katie Trauth Taylor. Katie's been slogging it out on the fundraising circuit, and she successfully closed a round for her startup earlier this year. And I asked her what advice she would have for entrepreneurs today, and her encouragement to entrepreneurs is don't be afraid to claim and own your status as a Midwest startup. We're capital efficient, we have a ton of grit and resilience, and we won't give up. And I definitely agree with her on that for sure. So with that as a backdrop, let's take a look at how capital is flowing in Ohio specifically. But before we dive into the data, I'll tell you how we compiled it. We compile data from various sources, and we spend a fair amount of time correcting errors and inconsistencies, and in some cases confirming with the company. And then we create custom tags for the funding stage, geography, and industry. And then we publish the results for all of the attendees at our events because we're a grassroots collaborative group, and we like to share this information freely in a pay-it-forward kind of way. However, we don't claim to be perfect. If you have any additions or corrections, we'd love to receive that information, and you can send an email to us at data@smartmoneyventures.com. So let's dive into the deals from the first 6 months of this year. First, we're going to zoom out and look at all of the capital flowing into Ohio. $27 billion of investment capital flowed into Ohio-based companies during the first 6 months of this year. And here's how that money breaks down. In blue, you can see that large public companies raised the bulk of the dollars with $17 billion, followed by debt deals in brown for $9 billion, and venture capital is that 3% sliver in dark blue at the top with $780 million, followed by grants at less than 1%. So obviously, venture capital in Ohio is currently a very small portion of the total capital flowing into the state. Now, this chart's based on dollars, but when we look at it based on deal count, as you can see here, about half of the deal volume, 146 deals to be exact, were venture capital and angel deals. And that's the part that I personally care about because that's where I've lived most of my career. So we've got 146 deals in venture. Let's take a look at the size of those deals. We had one really big deal that raised over 100 million so far this year, and we're going to take a look at that one in a minute. Another 18 companies raised at least 10 million. And there was another 49 startup companies in Ohio that raised at least $1 million, but less than 10. So now we can look at the breakdown by industry. On the far left in blue, you can see that technology and software companies raised the most money with over 249 million in the first 6 months of this year, followed by life sciences and healthcare at 219 million in brown, and the rest was professional services, food, beverage, and ag tech, and several other areas. So that's the dollars. Let's look at how the deal count breaks down. On the left in blue, you can see the technology and software startups closed 48 deals so far this year, followed by life sciences with 44, professional services, and the other industries as well. But the most interesting slide is where we show deals by stage of development. From left to right, we had 25 incubator deals in blue, 18 pre-seed deals, And the seed funding category is clearly the largest with 38 deals. And to the right of that, we had 8 Series A deals, we had 3 Series B, and on down the line. Now, I want to point out a new trend that we're seeing on this chart. There's 33 deals that do not specify a specific series. They're only categorized as early stage or late stage. And I believe that this is because many of them are bridge rounds and they don't want to call it really a Series A or a B deal. But my favorite part about this chart is that it shows we have a decent crop of seed stage startup companies that are getting funded here in Ohio. And I want to encourage everyone to rally around these companies because if they're successful, then we'll all be successful. Now let's take a look at the geographic breakdown. When it comes to dollars, you can see in blue that Cincinnati area startups pulled in the most with 301 million for the first half, followed by Cleveland and the Northeast region and brown with 27%, followed by Columbus and Central Ohio at 25%. And when we look at the deal counts, Cleveland had the most deals with 53, followed by Cincinnati at 37, Columbus at 36, Toledo with 10, and Dayton and Athens in the single digits so far this year. So let's zoom out and see how venture capital has flowed into Ohio over the last several years. Over the last 8 years, venture capital has been flowing into Ohio, following a trend that's very similar to national averages. We had a peak in 21 and 22, which was true across the country, and then everybody took a haircut in 23, and now we're starting to tick back up. So Ohio's trend is fairly consistent with national trends. So now let's take a closer look at specific deals this year, starting with the largest deals that got done. So far this year, the largest one was for 115 million raised by 80 Acres Farms. This round was later stage development capital from deep-pocketed investors like Barclays, General Atlantic, Siemens, and several other large investors. And I'll tell you more about the company when we get to the All-Star section. But now let's take a look at this year's $10 million club. In life sciences, we had 8 deals over 10 million so far this year, with the largest being Syndome at 40 million, Phamily at 25, Identify Sensors raised 20 million, and on down the line. It's great to see that these companies are successfully raising large amounts of capital here in Ohio, and this is hopefully going to pave the way for even more investments like this going forward. In technology, software, data, and AI, we're tracking 6 deals over 10 million so far this year. And the biggest one was Asset Watch, which raised another 75 million this year. And they are all-stars from the class of 2024. So congratulations to Will Zell and the rest of the team there. Keep up the great work. Matic Insurance raised 30 million. And there's great stories behind each of these companies, and I wish I had time to tell you about all of them. But we'll give everyone an opportunity to get copies of these slides at the end. In the other categories, we had one big deal in automotive so far this year. Endera Motors runs EV fleets, and they raised $36 million. And we had several others in professional services as well that were over 10 million. Now, I'm going to show you all of the 38 seed deals in a minute. But before that, we're going to announce the first wave of nominees for the Ohio Venture Pipeline All-Star class of 2025. The All-Star nominees are selected primarily based on the quality of their investor syndicate. Ideally, what we're looking for is a good mix of both local and out-of-state investors in their syndicate because we hope to see more of that. The first nominee for the class of 2025 is 80 Acres Farms. And as I mentioned before, they've raised the largest round in Ohio for the first half of this year at 115 million, primarily from large out-of-state investors. And this money's on top of the 255 million that they had already raised before. So this is an ag tech company that's scaling very rapidly. The company operates indoor vertical farms using 100% renewable electricity, 95% less water per pound of produce, and it's also pesticide free. You might have even purchased some of their products, their salad products in the grocery stores here. Company's headquartered in Hamilton, Ohio, near Cincinnati. The next All-Star nominee is Sonic Fire Tech. I have to say I'm fascinated by this one because they're using space technology to put out fires. If you go to their website, they have videos showing how they use acoustic wave technology to put out fires with no water and no chemicals. Now, it's also interesting because they raised money in April from one of the deepest pocket VCs in Silicon Valley, Khosla Ventures. So Khosla has over 16 billion of assets under management, and they were early investors in some of the iconic venture successes like DoorDash, Instacart, Stripe, Opendoor, and many others. Now, the co-founder and CEO, Jeff Bruder, he's done a lot of great work at NASA Glenn Research Center in Cleveland, and you can learn more about his story on Jeffrey Stern's Lay of the Land podcast, which I encourage you to check out as well. The next All-Star is Narratize with CEO and co-founder Katie Trauth Taylor. Many of you know Katie, and her journey has been really inspiring to watch. I'm really excited to have the opportunity to celebrate Katie and her team's success. They raised a seed round in January from a great group of investors led by North Coast Ventures, my friend Todd Fetterman over there, Engage Software, Comcast NBC Universal, the Ohio Angel Collective, Mike Supek and team, How Women Invest, Keyhorse Capital, and Centrifuge Capital as well. Narratize is an intelligence platform for product innovation, and they have an impressive customer list, including Comcast, Boeing, Delta, Colgate, and others. So congratulations, Katie and team, and we're cheering you on for continued growth and success. Next, we have Graici, a company that's expanding access to healthcare, education, and childcare. They raised a $3.5 million Series A round led by $1 billion fund in Austin, Texas called Sante Ventures. Jumpstart Ventures, North Coast Ventures, and OVO are all investors in prior rounds in the company. And the founder and CEO, Stephen McHale, is also a board member at Actual, which is another rapid growth company in Ohio that's raised over $40 million. Congratulations to Stephen and the team over there. Next up is Coologics, founded by Dr. Kimberly Langdon. Coologics raised a $3 million seed round in April from Dream Ventures in Las Vegas, Bold Ventures from Buffalo, Illinois Ventures, and the Ohio State Early Investor Network. Developed by Dr. Langdon, Coologics provides patented, drug-free, faster, and more effective treatments for vaginal infections. Next, we have Abre, which raised a $3.4 million venture round led by Peakspan with Jumpstart Ventures, Jobs Ohio Growth Capital Fund, and Golden Angel Investors as well. Matic Insurance raised a $30 million late-stage round from Vistara Growth, and Vistara is a $600 million venture fund that's based in Canada. Next, we have a semiconductor company, Niobium. They raised a $12.85 million round in March from Alumni Ventures and Silicon Catalyst Ventures. HDS, which is Health Plan Data Solutions, they raised a $15 million round led by MK Capital, and that's actually a Southern California VC firm that I know well. They also had local investors participating, including Tamarind Hill, Jobs Ohio Growth, and Rev1 Ventures. Phamily is part of John Health, and they were able to close a $25 million round from Darwin Ventures, which is another California fund with close to $700 million of assets under management. And Endera Motors, which is that EV fleet company, they raised $36 million from Magnetar, Pritchard Auto Stores, and several other deep-pocketed investors. And last but not least, Trailhead Biosystems raised a $20 million round in late-stage funding from Mac Capital, which is a New York-based hedge fund. So please join me in congratulating all of the Ohio Venture Pipeline All-Star nominees from the first half of this year. The other group of deals that I want to share with you are the seed deals. And the reason that seed deals matter is because just like the seedlings shown in this picture, each of these companies needs nurturing, care, and support, because we know statistically that not all of them are going to be successful in graduating to Series A financing. In fact, this chart from Crunchbase starts at the top with 2018, when you can see in dark blue that more than half of the seed deals at that time received follow-on financing. But then if you jump down to 2021, it flips. Many more in light blue did not receive follow-on financing, and that trend continues on down. As I mentioned before, in the first 6 months of this year, we identified 38 seed financings that were successfully completed, and we grouped them on this slide by geographic region. You can see that the Cincinnati metro area had the most seed deals, starting with 13, with Nutrinarc had a really good size seed round of 9.6 million. The Columbus metro area had 10 seed deals in the first half, followed by the Cleveland region with 8 and a handful in the other region as well. So everyone in our community right now has a role to play in the nurturing, care, and support of these companies. So here's the call to action. They all need customers first and foremost. And as you review the companies in this report, I encourage you to find 2 or 3 companies that you might be able to help. They all need introductions to customers and investors. And if they've raised money, they're probably recruiting for good team members, strategic partners, and industry experts as well. Making introductions is the core of any venture ecosystem. In fact, some of the most valuable people in an ecosystem are the super connectors, which is why all startups need a supportive and connected community. And one of the most valuable lessons I learned in California was it's not only important to have great programs, it's also important that our community be a collaborative, connected community. And we do have a great ecosystem. Ohio Third Frontier and Jobs Ohio are some of the most unique programs in the country. The ESP program has done amazing work building a foundation of entrepreneurial activity in programs. We also have industry nonprofits like Ohio Life Sciences and OhioX. They advocate for and support their members building companies here in Ohio. And we also have Techstars in Ohio now, and that's a huge win as well. We're also getting more local money involved in venture. Most of you know that the O.H.I.O Fund successfully raised $238 million so far this year, and they've already deployed $130 million of that across 19 deals. I'd like to congratulate the entire team at the O.H.I.O Fund, including Mark Kwame, Ray Leach, Jill Meyer, Mike Venerable, and Jeffrey Stern. To most people, 238 million sounds like a lot of money, but they're just getting started. They have plans to build the O.H.I.O Fund to a size that matches Ohio's GDP, and that number is currently over $800 billion. So if you want to learn more about the O.H.I.O Fund got started and what their plans are for the future, I encourage you to go to their website and check out the video in this roundtable discussion where they discuss all of the details. We also have rising stars in the angel groups in Ohio. Queen City Angels in Cincinnati and North Coast Ventures in Cleveland made the top 20 list of the Angel Capital Association's 2025 Angel Funders Report. So congratulations to them and all the entrepreneurs that they're funding across the region. Now, this report from the ACA also had another interesting insight. They found that angel groups are not just investing in their own backyard. In fact, many regions are investing as much as 40% of their capital outside their home region. And I love this quote: capital will travel for compelling opportunities. So, for the entrepreneurs, I encourage you to cast your net wider geographically as you look to raise funding for your startups. And the other reason you should be looking for capital outside of Ohio is this map from Carta. We already know that most of the venture money goes to California and the coasts, but how are we doing as a state in a region? Carta reports that the Midwest in light green is only drawing about 4% of nationwide venture capital, and Ohio is looking at about 0.54% according to their statistics. And I think we can do a whole lot bigger than that. But what I'm really concerned about is this headline. According to Carta, Ohio actually lost market share of venture capital from 2023 to 2024 relative to other states. Now, the first thing I'll say about this is that I didn't write this headline, so please don't shoot the messenger. In fact, I haven't validated these calculations, but when I look at our calculations, we do show a similar pattern that we actually did lose a little bit of market share. And I'm less concerned about the specific numbers because the important point is that we need to come together and reverse the trend and make sure that we're gaining market share. So the natural question is, how do we grow our piece of the venture capital and job growth pie? Now, obviously, we need more funding at all stages of development, and we invite you to share this report with your colleagues to help spread the word that this isn't flyover country anymore. And the evidence is the deals and all-stars featured in this report. And we also need more human capital, operators who know how to take that capital and build something worth 10x what the investors put in. I believe that we need an all of the above approach here. We need more homegrown entrepreneurs like Katie and our other All-Star Award recipients. We also need to be recruiting from other states in the region. And we need more boomerangers like me to bring experience from California and other leading innovation hubs. So I've said it before and I'll say it again. I believe we have all the ingredients needed to do significantly more venture funding in Ohio. Because when we look at the other key pillars of a thriving ecosystem, we already have all of the technical and scientific capital at all of the universities and research institutions across the state. And the community of people that participate in all the events around the state are providing the community engagement and support needed to make it all happen. So the path forward is simple. It takes a village to raise a crop of startup companies. And whatever role you play, whether you're an entrepreneur, an investor, a mentor, an advisor, a banker, lawyer, accountant, product development, or sales and marketing, we need you to continue to lean into this community. We need you to continue to suit up and show up at many of the events. We need you to connect these funded entrepreneurs with the capital and resources that they need to continue their growth. And if we can do that as a community, it'll pull us together so that we can grow Ohio's share of the most powerful driver of high-paying jobs and win together. So in closing, I want to encourage you to think bigger so that we can grow bigger. Because we're at the beginning of the largest tech disruption cycle that the world's ever seen. And I believe that we're capable of doing a lot more venture deals than we currently are. In closing, I'd like to point out that Ohio's startup ecosystem actually reminds me a lot of what San Diego looked like when I moved there in the early 90s. At the time, most of the venture capital money was in San Francisco Bay Area, and we actually had to work hard to convince VCs in Silicon Valley to invest in San Diego companies because they didn't want to get on a plane to go to board meetings. Well, thankfully, times have changed and capital is portable now. So we have a big opportunity to grow our share of the venture capital pie here in the Midwest using parts of the playbook that worked in Southern California. And that playbook is really simple. Share these stories of the great companies that are getting funded and growing here in this region. And I think most of you will agree that we have great stories to tell, but there's definitely room for us to do a better job of telling these stories to the right people in the right place at the right time. We're going to be hosting the Ohio Venture Pipeline at the iconic Ohio State House in the spring to honor these and all of the other OVP All-Stars for the year and the investors who are making it all happen. So I'd like to invite everyone to join us. If you'd like to receive an invitation to our State House event, please email me at jd@ohioventurepipeline.com and we'll be sure you get an invitation. Thank you for watching, and we hope to see you at the State House in the spring.